Imagine you're 5 years old and you just learned that if you dig a hole in your backyard, you might find treasure. So you start digging. Then your friend starts digging. Then the whole neighborhood starts digging. Everyone's convinced they're going to strike gold. People are even buying shovels they can't afford because they're so sure the treasure is real. That's basically what happened with the dot-com bubble, except instead of kids with shovels, it was grown adults with briefcases and millions of dollars. Let me take you back to the late 1990s. The internet had just become a thing that regular people could use at home. Before this, computers were these clunky machines that only businesses and tech nerds cared about. But suddenly, everyone was getting online. People were sending emails, browsing websites, and companies were scrambling to figure out how to use this new technology. Now here's where things get interesting. Investors looked at the internet and thought, this is it. This is the future. Everything is going to change. And they weren't wrong about that part. The internet did change everything. But what they got wrong was thinking that every single company with a website was going to make them rich. It's like if you opened a lemonade stand and I immediately offered you $10,000 for half of your business before you even sold a single cup. That's not smart, right? But that's exactly what was happening. Companies would come up with an idea, slap .com at the end of their name, and suddenly investors were throwing money at them like confetti at a parade. I remember reading about one company that spent millions of dollars on Super Bowl ads, even though they barely had any customers. Think about that for a second. They spent more money on a single commercial than most people make in their entire lives, and they weren't even making a profit yet. They just assumed the customers would come eventually. The stock market went absolutely crazy during this time. The NASDAQ, which is the stock exchange where most tech companies are listed, shot up like a rocket. Between 1995 and 2000, it increased by about 500%. If you had invested $10,000 at the start, you could have turned it into $60,000 in just 5 years. Everyone was making money, or at least it seemed that way on paper. People were quitting their regular jobs to become day traders, buying and selling stocks from their home computers. Your neighbor, your cousin, your dentist, everyone had a hot stock tip. Dinner conversations turned into investment strategy sessions. It felt like free money was just floating around and all you had to do was reach out and grab it. But here's the thing about bubbles. They're beautiful and shiny and fun to watch, but they always pop. Always. It's not a matter of if, it's a matter of when. And the bigger the bubble gets, the louder the pop. The cracks started showing in early 2000. Some of these dot-com companies were running out of money. They'd burned through millions in investor cash on fancy offices, expensive marketing campaigns, and big salaries, but they still weren't making any actual profit. When investors started asking, hey, when are you going to start making money, a lot of these companies didn't have a good answer. One by one, companies started failing. Small ones at first, then bigger ones. Stock prices that had been climbing for years suddenly started falling. And when people panic in the stock market, it's like a stampede. Everyone rushes for the exit at the same time. The NASDAQ peaked in March 2000 at over 5,000 points. By October 2002, it had fallen to around 1,100. That's a drop of almost 80%. Imagine if you had $100,000 invested and suddenly you only had $20,000 left. That's what happened to millions of people. Trillions of dollars in wealth just vanished. Not because someone stole it, but because it was never really there in the first place. It was based on hope and hype and the belief that stock prices would keep going up forever. When reality set in, all that imaginary wealth disappeared like morning fog. Some companies went bankrupt overnight. Pets.com is one of the most famous examples. They had this cute sock puppet mascot that everyone remembers, but the business model made no sense. They were selling heavy bags of dog food online and delivering them to people's homes, often at a loss. They spent a fortune on marketing but couldn't figure out how to actually make money. The company lasted less than 2 years. Webvan was another disaster. They wanted to deliver groceries to your door before anyone else was really doing it. Great idea, right? Except they spent hundreds of millions building giant warehouses and delivery trucks before they even knew if customers wanted the service. They burned through over $800 million in investor money before collapsing.
Thousands of people lost their jobs when these companies failed. Entire office buildings in Silicon Valley went from full to empty in a matter of months. People who thought they were millionaires on paper because of their company's stock options suddenly had nothing.
But the pain wasn't limited to Silicon Valley. Regular people who had invested their retirement savings in tech stocks watched their nest eggs shrink. Some folks had to delay retirement. Others had to go back to work. The psychological impact was huge, too. People felt foolish for believing the hype. So what went wrong? How did so many smart people make such a massive mistake? Well, it comes down to a few key things. First, people confused a good idea with a good investment. Yes, the internet was revolutionary, but that doesn't mean every internet company was worth billions of dollars. It's like saying, because electricity is important, every company that uses electricity must be valuable. That logic doesn't hold up. Second, traditional business metrics went out the window. Normally, you'd look at things like revenue, profit, and cash flow to determine if a company was doing well, but during the dot-com era, people started making up new metrics. They'd say things like, we're not profitable yet, but look at our user growth. Or they'd brag about website traffic while ignoring the fact that traffic doesn't pay the bills unless you can convert it into actual sales. Third, there was a massive fear of missing out. When your coworker is making a fortune in tech stocks and you're not, it creates this intense pressure to jump in. Nobody wants to be the person who missed the boat, so people invested money they couldn't afford to lose, hoping to catch up. And finally, there was just too much money chasing too few good ideas. Venture capitalists and investors had billions to invest, and they were desperate to find the next big thing. This created a situation where companies could raise money based on a PowerPoint presentation and a dream. There was no accountability, no requirement to show an actual path to profitability. The dot-com crash taught us some valuable lessons that are still relevant today. The most important one is that fundamentals matter. A company needs to make more money than it spends. That sounds obvious, but during the bubble, people forgot this basic truth. Excitement and vision are great, but at the end of the day, a business needs to actually do business. Another lesson is that bubbles are easy to spot in hindsight, but hard to recognize when you're in the middle of one. Everyone thinks this time is different, but human nature doesn't change. Greed and fear drive markets, and when everyone's greedy at the same time, you're probably in bubble territory. We also learned that diversification matters. People who had all their money in tech stocks got wiped out. People who had a mix of different investments survived much better. Don't put all your eggs in one basket, especially if that basket is floating on hype. The interesting thing is we keep seeing similar patterns repeat. We had the housing bubble in 2008. More recently, we've seen speculation in cryptocurrencies and meme stocks. Human beings have short memories, and we tend to think we're smarter than the previous generation, but the same psychological forces are always at work. Does this mean you should never invest in new technology or exciting companies? No, not at all. Innovation is real, and investing in great companies can build wealth, but you need to be smart about it. Do your homework. Understand what you're investing in. Don't invest money you can't afford to lose, and be honest with yourself about whether you're investing or just gambling. The dot-com bubble was a painful but important chapter in financial history. It reminded us that markets can be irrational, that crowds can be wrong, and that there's no such thing as easy money. But it also showed us the resilience of the economy and the power of real innovation. Many of the companies that survived the crash, like Amazon and eBay, went on to change the world. The next time someone tells you about a can't-miss investment opportunity, remember those dot-com companies with their fancy offices and their Super Bowl ads. Remember that wealth built on hope alone doesn't last. And remember that the most important question you can ask is, how does this company actually make money? If they can't answer that question clearly, your money is probably better off somewhere else.